Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023 October-November Paper 4-1 question number 1. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. P Limited sells one product. To prepare the cash budget for the 3-month period ending on 31st January, so the 3-month period is for the months of November, December and January, the management accountant provided the following information. The first information we have is that P Limited has a markup of 50% on all sales. So this just means that our sales value is just equal to cost or the cost of sales multiplied by 1 plus 50%. So we're basically raising cost by 50% in order to arrive at our sales value, and we're given the sales amounts as well. So we have the actual sales for the months of September and October. Then we have the budgeted sales for the months of November, December and January. Then 10% of sales are on a cash basis. Okay, let's write this down. So for our sales, cash sales will be sales times 10%. Then the remaining customers, which will be the credit customers, pay 2 months after sales. So this just means that for the credit customers in the month of September, they will pay in the month of November. And it is estimated that 2% of that trade receivables will be irrecoverable. So this just means that out of our total credit customers, 2% will not be able to pay us, which means that only 98% of credit customers will be able to pay us. So the remaining sales will be of credit sales. And this is just going to be the sales times 90%. And this is the total of the credit sales. And out of the total of the credit sales, 2% will not be able to pay us because those will be irrecoverable debts now, which means that the total credit sales is just going to be sales times 88.2%. And remember, this is the amount that will be paid after 2 months. Okay. Then all purchases are on credit. P Limited is allowed to pay 2 months after purchase, similar to what we did for sales. However, P Limited always pays 1 month after purchase to get a cash discount of 1.5%. Okay, so all purchase will be on credit. So that is just purchase times 100%, or we don't have to write anything in this case. And we will also get a cash discount of 1.5%, which means that we won't have to pay 1.5%. So this will just be purchase times 98.5%. And this will be paid after 1 month. So this just means that purchases for the month of September will be paid for in the month of October. Then it is the policy of P Limited to maintain an inventory level at the end of each month sufficient to meet 40% of the sales of the coming month. Okay, so our closing inventory, okay, I'll write this down as well. So closing inventory should be 40% of next month's. And remember, in this case, we are told the sales, right? But in this case, rather than the units, we have been given the sales value. But we cannot incorporate sales value as part of our closing inventory, since closing inventory will only be valued at its cost. That is why we can just include this as next month's corresponding purchases or the next month's corresponding cost of sales. That will be our closing inventory for each month. Then depreciation and other operating expenses. Okay, we have depreciation as well. Total 131,000 each month. The other operating expenses are paid in the month in which they are incurred. But remember, the purpose of this question was to prepare cash budget. And depreciation is a non-cash expense, which means that we should be excluding the amount of depreciation from this 131,000. Then we have plant and equipment, that's our non-current asset, are depreciated at the rate of 15% per annum using the straight line method, which means that we can apply this rate of depreciation to our cost. Then all the plant and equipment were bought 3 years ago for 124,000. Let's calculate the depreciation. But remember, we require the depreciation per month. And this is the rate per annum. So we start with a cost of 124,000. We multiply it by the rate per annum. And this would give the depreciation for 1 year. But since we require the depreciation per month, we can just divide it by 12. And this gives the depreciation per month to be 1,550. Now we can correct our operating expenses. So we start with the given amount of 131,000. And now we need to exclude the depreciation per month of 1,550. This results in the amount of 129,450. And this will be paid in the month in which they are incurred. Then the cash at bank on 1st November would be 95,000. So this will be the opening balance for the month of November. That's all of the information. Let's move towards the first question. We now need to see two purposes of preparing a cash budget. So whenever you're asked any questions regarding the purpose of cash budget, you can split the same thing into two different answers. So by preparing a cash budget, you figure out two things. The first one is a negative cash balance, which is cash deficit. And in such cases, it helps the management to arrange some sort of funding in advance so that the company won't have to go through the cash deficit. Then another scenario is where there would be a positive cash amount that results in cash surplus, and in such cases the management can decide in advance on which sectors to invest in so that the excess cash can be fully utilized. Those are the purposes of preparing a cash budget. Let's write it down. We can start with the deficit. To identify any cash deficit so that funding can be arranged in advance. The second one is to identify any cash surplus so that cash can be fully utilized by investing it. Okay, that's all for the first part. Let's move towards the second one. We now need to prepare the cash budget for each of the months November, December, and January. Okay, this is for the month of January. This is for December. This is for November. And cash budget is the format is pretty simple. We start with the opening cash balance, we add all of our receipts, we subtract all of the payments, then we get the closing cash balance, which will act as the opening cash balance for the next period. So let's start with the opening cash balance. We were given the opening cash balance for the month of November, and it was of 95,000. Let's write it down. And we do not know the opening cash balance for the months of December and January. So in order to figure that out, we first need to figure out the closing balance for the month of November. Now we'll move towards our receipt section. And the only income given within our information was for our sales. And sales are of two types. So we have cash sales and we have the credit sales. Let's first calculate the amount of cash sales. So amount of cash sales is just going to be sales of the current month multiplied by 10%. Right? And we're looking for the months of November, December, January. So that would be 390,000 times 10%, which is 39,000. 450,000 times 10%, which is 45,000. 375,000 times 10%, which is 37,500. Let's write it down. So for cash sales, we have 39,000, 45,000, and 37,500. Now for the credit sales, that is just going to be sales times 88.2%. But this sales should not be the sales of the current month, because this amount will only be paid after 2 months, right? And we've already concluded that within the month of November, we will be receiving the credit sales made in the month of September. So that should be 360,000 times 88.2%, which results in the amount of 317,520. That's 317,520, and we exclude the irrecoverable debt because that amount will not be received. Now for the month of December, we will be receiving the amount for credit sales made in the month of October. So that will be 420,000 times 88.2%, which results in the amount of 370,440. Then we repeat the same process for January. In January, we will be receiving the amount for credit sales made in the month of November. So that's just going to be 390,000 times 88.2%, which results in 343,980. that is all for our receipts section. So we can figure out the total of our receipts. For the month of November, that's 39,000 plus 317,520, which results in 356,520. For the month of December, that's 45,000 plus 370,440, which results in 415,440. For the month of January, that's 37,500 plus 343,980, which results in 381,480. That is all for our receipts section. We can now move towards the payment section. And the very first payment that we need to make would be for the credit purchases. But we still have to figure out the amount that we would pay for these credit purchases, because no information regarding purchases were given. We were only told that we had a markup of 50%. And remember, this question is based on values rather than the units, so it might be a bit tricky, but the format will be the same. And remember, whenever we previously created a purchases budget, we used to start with the sales in terms of units. We used to subtract the opening inventory, again units. Then we used to add the closing inventory units. And in this case, we're talking in terms of values, right? So in terms of values, we cannot include the sales value because this will incorporate the profit factor as well, and we cannot value our purchases as well as the opening and closing inventory at the sales value. We can only value it at cost. That is why we need to transform the sales value to our cost of sales. Then we figure out the opening inventory based on the cost of sales and the closing inventory based on the cost of sales as well. So we will be following this format in order to figure out the total purchases made for each month. Then the payment for purchases will be after 1 month. So we just have to shift the payment to 1 month later and figure out the values that will actually be paid. So let's start with calculating the cost of sales. And since we are paying it after 1 month, within the month of November, we will be paying the purchases made for in the month of October. So we need to start our budget from the months of October, and we need to figure it out for November, December, and I think it would be easier if we calculated January as well, since our closing inventory is based on next month's cost of sales. So in order to calculate the closing inventory of December, we need the cost of sales of January. Yeah, so that will be for the 4 months of October, November, December, and January. We are first starting with our cost of sales. And we already have the sales value, so it will be very easy to calculate our cost of sales. We can just transform this formula. If we're trying to figure out the cost, it is just going to be sales divided by 1 plus 50%, which is 1.5. So if we are trying to calculate the cost of sales for the month of October, that would just be the sales value divided by 1.5, which is 420,000 divided by 1.5, which results in 280,000. Then we repeat the same process for the remaining months. For November, that will be 390,000 divided by 1.5, which results in 260,000. Then for the month of December, that will be 450,000 divided by 1.5, which results in 300,000. And for the month of January, that will be 375,000 divided by 1.5, which results in 250,000. Now the next step would be to subtract all of the opening inventory. Then we need to add all of the closing inventory. Okay, let's start with the closing inventory first, because that is just 40% of next month's cost of sales. So if you're trying to figure out the closing inventory for the month of October, that is just going to be 40% of November's cost of sales. So that's 40% times 260,000, which results in 104,000. Then for the month of November, that will be 40% times 300,000, which results in the value of 120,000. For the month of December, that will be 40% times 250,000, which results in the value of 100,000. Now remember that this month's closing inventory will act as the next month's opening inventory. So we can just transfer these values. So for the month of November, the opening inventory will be 104,000. For the month of December, the opening inventory will be 120,000. And for the month of January, the opening inventory will be 100,000. And yeah, we don't need to calculate anything more for January, because we're only concerned with the purchases made in the months of October, November, and December. Now, the one missing thing is the opening inventory for the month of October. So we can understand this as the closing inventory for the month of September. right? And whenever we're calculating the closing inventory, that is just going to be 40% of next month's cost of sales. So the closing inventory for the month of September is just going to be 40% of 280,000, which results in 112,000. Now we already have our cost of sales, opening inventory, as well as the closing inventory, so we can figure out the purchases for the month. For the month of October, that will be 280,000 minus 112,000 plus 104,000, which results in 272,000. For the month of November, that will be 260,000 minus 104,000 plus 120,000, which results in 276,000. And for the month of December, that will be 300,000 minus 120,000 plus 100,000, which results in 280,000. And remember, this is the credit purchases, right? So the payment will be made after 1 month, and the payment made will be purchases amount multiplied by 98.5%. Now we are trying to figure out the payment made for the credit purchases, right? So the payment made in the month of November will be for the credit purchases made in the month of October, and we need to multiply this figure by 98.5%. So that will just be 272,000 times 98.5%, which results in 267,920. We repeat the same process for the remaining 2 months as well. For the payment made in the month of December, that will be 276,000 multiplied by 98.5%, which results in 271,860. And finally, for the payments made in the month of January, that will be 280,000 multiplied by 98.5%, which results in the value of 275,800. Alright, we are done with the purchases. Okay, we have utilized this. We've included the sales, we've included purchases, we've included the closing inventory. Then we have our operating expenses after excluding the depreciation for the month, because this is a non-cash expense. So we also need to include the operating expenses of 129,450 for each of the 3 months within our payment section. Let's write it down. So that will be our operating expenses of 129,450 for each of the 3 months. And that is all the information regarding our payments. We can now figure out the total for our payments. For the month of November, that will be 267,920 plus 129,450, which results in 397,370. For the month of December, that's 271,860 plus 129,450, which results in 401,310. And for the month of January, that's 275,800 plus 129,450, which results in 405,250. Now we can figure out our closing cash balance. And closing cash balance is just going to be the opening balance plus receipts minus payments. So for the month of November, that will be 95,000 plus 356,520 minus 397,370, which results in 54,150. Now the closing balance for the month of November will act as the opening balance for the month of December. So the closing balance for December will be 54,150 plus 415,440 minus 401,310, which results in 68,280. Again, this will act as the opening balance for January. And the closing balance for January will be 68,280 plus 381,480 minus 405,250, which results in 44,510. That is all for the second part of this question. Let's move towards the next part. Okay, you are also given the working section, and in this particular working box, you need to show the workings for all of your purchases, as well as the workings for sales, closing inventory, and the operating expenses. So you just basically need to include everything that I've written down in the question paper within that workings section or workings box. Now for the third part, we need to prepare the budgeted statement of profit or loss for the 3-month budgeted period ending 31st January. We need to start our answer with the gross profit. Okay, so we just need to prepare the statement of profit or loss for the 3 months, that's November, December, and January. And we have to start with the gross profit. So remember, gross profit is just the difference between your sales and the cost of sales. And we've already figured out our sales. It was given in the question, but we've already figured out our cost of sales as well. So it'll be easier that way to calculate our gross profit. So the first thing that we need will be the total of our sales for the months of November, December, January. So that's 390,000 plus 450,000 plus 375,000, which results in 1,215,000. That's the total of our sales. Now we need to calculate the total of our cost of sales as well. For the months of November, December, January, that's 260,000 plus 300,000 plus 250,000, which results in 810,000. Now, gross profit is just the difference between these two values. So that will be 1,215,000 minus 810,000, which results in the gross profit of 405,000. Let's write it down. So we have gross profit of 405,000. Now, the next step would be to add any other income, right? And in this case, the income will be the discount received while making the purchases. And the purchases amounts for the months of October, November, December is right here. So we need to calculate the total of the purchases first. That's 272,000 plus 276,000 plus 280,000, which results in 828,000. And the discount rate was of 1.5%, right? So 1.5% of this amount will be received as our discount. And the total of the discounts received will be 12,420. We need to add this as our other income to the gross profit. So that will be 12,420. Let's calculate the total of our gross profit and the income. That's 405,000 plus 12,420, which results in 417,420. Now we need to include all of our overheads. So the very first overhead will be our operating expenses. And within this part, the operating expenses should also include the depreciation, because now we're talking about the statement of profit or loss. So we need to refer back to the original amount given within the question, which was 131,000. And this is the charge per month, but we're trying to figure out the statement of profit and loss for 3 months. So we just need to multiply this by 3. That will be 131,000 times 3, which results in 393,000. Now another expense was of irrecoverable debt. And remember, for the calculation of irrecoverable debt, we cannot be using this amount of sales, because the irrecoverable debt will occur on our credit sales values, right? So again, for the month of November, that was the credit sales for September. For the month of December, that was the credit sales of October. And for the month of January, that was the credit sales of November. So we first need to figure out the total of the credit sales for September, October, November. So that will be 360,000 plus 420,000 plus 390,000 multiplied by 90%, because 90% was made on a credit basis. This results in 1,053,000. Now, in order to calculate our irrecoverable debt, that will just be 2% of the trade receivables, and the total of trade receivables is this amount. So 2% is just going to be that's 1,053,000 times 2%, which results in 21,060. That will be the amount of our irrecoverable debts. And that will be all for our overheads. Let's figure out the total. 393,000 plus 21,060, which results in 414,060. We need to subtract this in order to get our profit. And this is the budgeted statement of profit or loss, so we can label it as budgeted profit. That will be 417,420 minus 414,060, which results in 3,360. That's all for the third part of this question. Again, we were given the working section, and in this particular box, you need to show your workings for the discount received, which we have done above, the workings for irrecoverable debt, which we've again done above. So you just need to copy those workings down in this particular box. Now, we're given additional information. To improve the future cash position, the directors have two options. The first one is to offer a cash discount of 2.5% to credit customers if they pay 1 month after sales. Right now, they are paying 2 months after sales, and it is estimated that 80% of the credit customers will take the cash discount. Then, option 2 is to pay the suppliers 2 months after the purchases, and currently we are paying 1 month after the purchase. Okay, now we need to advise the directors which option, if either, they should choose. We need to justify our answer. This is of 7 marks. Okay, let us write down 3 comments for option 1. For option 1, we are now offering a cash discount if the credit customers pay 1 month after sales. So if the credit customers take this cash discount, then it means that cash will be received quicker. That's the first point that we can write down. Cash will be received quicker. Then the second thing that we can write down is we have no idea whether or not the credit customers would take this discount, right? So we do not know if the credit customers take the discount. We can write it as credit customers may not take the cash discount. And in this case, we are offering the discount, right? So discount allowed will increase our expenses, which will reduce the profit. Discount allowed will increase expenses, which will reduce profit. Okay, that's all for option 1. Now let's move towards option 2. In option 2, we are now considering paying the suppliers 2 months after the purchase. Currently, we are paying after 1 month. And by paying 1 month after the purchase, we will be receiving a discount, right? Now, if we pay after 2 months, there will be no discount. So the first thing that we can write down is the discount received will be lost. And due to this factor, our profit will be reduced because now there will be no additional income. And currently we are paying 1 month after the purchases, right? But if we switch towards paying 2 months after the purchases, it might hamper the credibility of our company with the suppliers. The suppliers might not trust us with any bulk orders with the fear of irrecoverable debts in the future. So a delay in the payment period may hamper the credibility with the suppliers. Okay, now we need to make a decision, and the decision should be made such that we can improve the future cash position. So I would suggest the directors to choose option 2 because cash will be held for a further month within the company, so that might improve the liquidity position of the company. And I'll not go with option 1 because we do not know whether or not the credit customers might be inclined to pay quicker just by offering a cash discount of 2.5%. So we have no basis on whether or not the cash will be coming in quicker into the business. That's why I'll be siding with option 2. So the decision is that the directors should choose option 2 as cash will be held for a further month. That's all for the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.